The simple concept that I'm about to share with you today turned me from a losing trader to a profitable trader in a matter of few months. Unfortunately, it took me many years to learn about that concept, and I wish I knew that earlier. With that concept, I'm able now to identify when it's time to risk more money and make big gains and when it's time to sit still and wait for the perfect market conditions. As I started, I got lucky. I got a lot of winning trades and I thought I know everything. I don't need to learn much. And then all of a sudden things changed. I started losing money, started giving back profits. I did not know what's happening. And I thought the reason is that I don't know enough. I thought I have to add more strategies. I have to try out different strategies, try different instruments, and maybe add more indicators, fundamental analysis. I switched from trading stocks to Forex, back to stocks, and I could not figure out how come the strategy that I've been taught worked for a while and then all of a sudden stopped working. And that was kind of repetitive until I finally figured it out and realized that it's not my mentor's fault. It's not the instruments that you're trading, and you do not need more indicators or knowledge. You simply need to understand the different market cycles. You need to know when it's a risk on cycle and when it's a risk off cycle. The market is changing and goes through 4 cycles. And I'm about to share them with you in detail on my charts. But I want you to know that throughout these different cycles, you will have different strategies, different setups, different risk management, and different trade management approaches. So if you're applying the same strategy throughout these different cycles, it will not work. It will work in 1 out of 4 cycles, and the other 3 are not going to work, and you will not know why is it not working and why your strategy is not profitable. So whatever you're doing right now, if you find yourself in a situation that nothing is working and you think to change the strategy or try out different instruments, I want you to stop and pay attention to that video, because at the end of the video, you will have a completely different view on the markets and completely different understanding. This concept works not only on the stock market, it works in Forex, commodities, all markets, and also all time frames. So it's crucial to understand that before you put any indicators, before you try to add more strategies or blame your mentor or anything like that. This is the number 1 step I wish I knew earlier, and I wish I understood early in my trading career, instead of trying to trade and look for entries and exits and holy grail strategies, because none of this matters. Even if you have the perfect strategy, this perfect strategy will work only in 1 cycle out of 4. Now let's go ahead and see how that exactly looks like. There are 4 different cycles on the market: accumulation cycle, uptrending cycle, distribution cycle, downtrending cycle, and then going back into accumulation cycle. Accumulation cycle normally happens after a longer downtrend. This is where more buyers are stepping in when the market is finding a bottom, and you start seeing a little bit of a sideways price action with slightly higher lows. It's a clean looking chart. We do not know how long this cycle is going to last. So sometimes it can last a few weeks, sometimes it can last a few days, sometimes even a few months. You can imagine that as an area where the market is building momentum and about to break out and transition into a nice uptrend. This uptrend here is the cycle that you want to be invested the most. So if you're a trend trader, this is the cycle you want to be in. If you're a swing trader, this is the cycle where you're going to be able to make the most amount of your money. In other words, this is a risk on market. So when you have this market, you can buy every single dip. Everything is uptrending. It's easily and smoothly going up, and you don't have surprises. Most of the times when you see people teaching something on the internet, people are telling you about this uptrending cycle only. And that's why most of the people end up making profits during that cycle, but then they're struggling, for example, in a distribution cycle, downtrending cycle, or in an accumulation cycle. Now, after this uptrending cycle is going for a while, at some point, you will going to see a little bit more of a slowdown. So you're not going to see this nice big breakout. You will see less momentum. The breakouts are going to be just a tiny bit, and then you're going to see a little bit of a pullback immediately. And so this is your sign that there are no more aggressive buyers, and this is where we are about to transition in a distribution cycle. The distribution cycle, in my personal experience, is one of the hardest cycles to trade, because you can imagine that's like a fight between bulls and bears. You see a lot of failed breakouts. Normally a dip that you're about to buy, it's not going to work. It's going to be a failed bounce, and it's going to be very choppy with big range, which is challenging, especially if you're trading with the same size. This is why it's so crucial to know that in a distribution cycle, your size should be different compared to your size in an uptrending cycle or in an accumulation cycle, because in a distribution cycle, everything is out of control. You don't have a clear direction. You have failed signals, very fast moves, big ranges, volatility is increasing, and so definitely one of the hardest markets to trade. And then at some point, if the bears take over and sellers take control, we're going to transition into a downtrending cycle. This downtrending cycle, you're not going to see a lot on the stock market. Stock market is most of the time going up, and if you see a downtrend, it's not going to last long. So normally a downtrend on the stock market is lasting somewhere between 2 to 3 months overall in general. And of course, there are some exceptions, don't get me wrong. In 2022, we had a little bit longer downtrending cycle where we saw a downtrend lasting for more than a year. And so you can have that. We don't know when is this going to happen. Based on my experience over the last 10, 11 years, is that the downtrending cycles last somewhere between 2 to 3 months. And then at some point, we're going to go back into accumulation where buyers are going to step in. You're going to see a little bit more sideways price action, and at some point back into an uptrend. Now, after all these years, I learned to adapt my trading style, my risk management, and my setups based on different cycles. And so our number one goal is to buy at the right spot so that we can profit at max at a certain point. For example, in an accumulation cycle, you want to buy here at the bottom and sell at the top. In an accumulation cycle, we're not looking for the breakout, and that's because we don't know when the breakout is going to happen. Is it going to happen now, next week, maybe in 6 months? So you don't want to stay there for 6 months and wait the breakout to happen. That's why you want to buy as low as you can around support, or where is the liquidity zone. If you have a support zone at the low of the box, you have a range. We want to buy at the lowest part of the range and sell at the upper part of the range. You don't want to be in the middle. You don't want to buy in the middle of the range, and you definitely don't want to buy at the top of the range. So normally the entry is right here at the bottom and the exit should be at the top. The situation looks differently in an uptrending cycle. In an uptrending cycle, you're not going to see huge pullbacks. So in other words, the pullbacks, especially if you get into the market somewhere here, they're going to be very little and short. And so once this breaks out, the breakout zone normally is going to be tested. This is your prime opportunity to go in big, because if you're aware that we're about to transition from an accumulation to an uptrending cycle, you will have the opportunity to make really big gains here. And so you can add on dip, keep holding these positions even over months. And remember, you can use that on any market, any time frame. I'm talking specifically about the stock market because this is my favorite market, and that's what I trade the most based on the daily chart. And so at some point, the sellers are going to step in and you're going to see failed breakouts, less momentum, more choppiness. This is your sign to get out of the market. So you don't have time to give back your profits. And by the way, this is the cycle where most of the traders lose their money that they've made in an uptrending cycle. You don't want to be in that position. Now, if you get out of your positions, that and you made pretty decent amounts of money in the uptrending cycle, in a distribution cycle, most of the time I would personally prefer to sit still and wait it out. So there are two options you can trade the distribution cycle. Number one is you can short here at the top and cover around support, because your probability for success is very, very high if you short at the top. The disadvantage though is that especially if you're trading the stock market, you're against the trend, and shorting the stock market overall is not one of the easiest things to do. So if it's me, I would still prefer to buy some of the dips here and move my stop loss very quickly to break even zone, so that I'm quickly out of the risk, because again, this is a volatile cycle full of a lot of choppiness. So you want to get out of this noise and secure your positions and do not lose any money. When we switch to a downtrending cycle, this is the cycle that I still prefer to buy the dips on the stock market, because I know that overall my edge is on the long side. So if I just go in, buy every single dip around a deeper support zone, I would still be better off than shorting it. Now, of course, you can find certain stocks to short if that's something you want to do. But again, the number one goal should be to find your edge. And if you're trading the stock market, if you're trading the indices, going long is actually much easier than trying to time a good short, and also your probability for success are going to be much higher. Now, if you're using that strategy on other markets, yes, you can short the top, you can short the resistance zones here and take profits and cover around support. And so everything repeats itself over and over again. Once the downtrending cycle is over, we're going back to accumulation cycle. Now, I want to show you how that looks like on the chart so that you're prepared next time you see that. So as we can see here on the QQQ, I want to focus here on this piece of the chart and show you the exact price action. So we see here we went through a little bit of a push here, slowed down slightly, and you see a very nice and steady uptrend. This is a typical uptrending phase. You see higher highs, higher lows, everything is moving slowly and steady, and there is not a lot of volatility. You also see the pullbacks are not huge, so you just have a little bit of pullbacks, another move up, tiny bit of a pullback, move up, another nice pullback. This is a very slow and nice move. So if you have a position and you start adding to each dip here every 3 to 5 days, this is my rule, 3 to 5 red days, and you keep adding to your existing long position or open a new position and take the swings to the upside, you should be able to make a sizable amount of money. And if you don't use the QQQ, I highly suggest going to the TQQ, which is the 3-time leveraged ETF, and it is much cheaper to buy. After this nice move here, you start seeing all of a sudden a little bit more increased volatility. So this was the beginning of a distribution cycle, and then eventually of a downtrending cycle. Downtrending cycles, especially on the QQQ or the US stock market, they're not going to be huge. So don't expect something wild to happen or to last for long periods of time, because that's not gonna happen. Green candle trying to bounce, failed bounce, and I want you to pay attention at the candlesticks, because the candlesticks are telling you the story. You really don't need fancy indicators or some wild stuff on the chart. Really, if you pay attention close to the candlesticks and what happens around the high and the low of the candlesticks and certain support and resistance levels, you will know what's about to happen next. So this was here the high of that candlestick, and it was trying to break out here. It made a green candlestick, but eventually it gave it back, and we see another red candle. This is here your first sign that there are more sellers stepping in. There are not enough buyers to push the price through the high and continue further. So if you're someone who is trying to buy around this zone, you're definitely at the wrong spot. So first of all, the chart went for a very long uptrend. You have several signs that the market is about to switch, and you see here it was already here overbought. So these are your very first signs that we might see a shift, and eventually it broke this support zone. So this is your small distribution zone here. It break through this support zone and break even below the 50 EMA, bounce back up, and it started a very small and short downtrend. And here as well, you see a nice doji candlestick right at support. So if you bought here in the next red candlestick, if you see that, you know that that is definitely not over yet, and you should be a little bit more patient. So again, to figure out that, you must look for the candlesticks, size of the candlesticks, how is the market reacting around certain support and resistance levels, and most importantly, as soon as you see that distribution cycle is happening, reduce your size, because if you trade small, you're going to prevent giving back your nice profits from an uptrending phase. So that's the whole point, to maximize on the best phases and be able to capture big moves and protect your gains in the phases that are not very favorable for us. At some point, this touched the 200 EMA, it was oversold, 30 RSI, which is one of my go-to and favorite setups, and then eventually it bounced huge up and started to go into another nice uptrend. Same thing here around this zone, started to struggle to break out. You see right at the breakout zone, big red candlestick, then trying to break out again right at the resistance red candlestick. So it does not have enough momentum to follow through. There are not enough buyers. Another big red candle. So all these are signs the market is not ready. It's not ready to break out. Small distribution, and this time it didn't really go into a downtrend, but you would have been able actually to capture a very nice move here because it continued its way up into an uptrend. And this is something very typical for the stock market. You're not going to see that a lot on Forex. If the market is dropping and sometimes it's going from a distribution straight into a potential accumulation and an uptrend, you're not going to see that in Forex, for example. Because the market most of the time goes up, your edge is, as I mentioned before, on the upside. So if you're buying, you're going to be much better off. Last chart that looks similar to that is the Microsoft ETF, leveraged ETF, so MSFU, or if you're trading Microsoft, you can also type MSFT, so that's Microsoft pretty much. Same thing here, going through a very nice uptrend, and then eventually started to break out, followed by a big red candlestick, trying to break out again, but there is no follow through, not enough buyers are stepping in, red candlestick. So this is here your distribution and your sign that you should stay out of that. Do not buy there, don't go in big size there, because all you're gonna do is mess the whole thing up and end up with losses and drawdowns. So if you want to avoid that, I would totally stay away from that. Eventually it dropped, made a very little downtrend, and again, as soon as it touches the 200 EMA and oversold, this is a high prime buy setup for me with a very high risk versus reward ratio. It bounced back up and again went into another nice uptrend. Small uptrend actually, because right after another distribution happened, trying to break out. You see the price action every time it's reaching the resistance, every time it's reaching the highs over here, there are more sellers stepping in, and you see red candles. Sometimes these red candles are bearish engulfing candles, bigger than the green candles. Sometimes they're reversal candles. The point is that the market is struggling to break out, and then if you see more and more red candles than green candles, this is your sign that the market is about to drop again. But that's your sign to not to buy here first of all, and to wait for that deeper pullback that you can step in with bigger size at a better price and have better risk versus reward. So I hope that video helped you a little bit more to figure out what are the spots on the chart where you should stick with your cash and don't risk anything, and where are the prime spots that you can buy at a lower price with a better risk reward ratio. If you want to get our weekly gains guide, where we are bringing up every single week free report with our growth stocks and market analysis, feel free to use the link below in the description box to sign up. It's totally free. So I can't wait to see you back here on our channel again. Thank you so much, and bye for now.